Ladies and gentlemen, welcome back to the channel. Today we're going to be talking about elephant money strategies. 3 elephant money strategies you can use to earn passive income. Ladies and gentlemen, I'm going to share with you these 3 strategies. We're going to talk about the sustainability or the viability of these strategies today as well. I'm also going to show you something that really kind of shocked me about this project. I mean, it really is a little bit of a stroke of genius. We'll talk about that as well. I'm also going to let you know a little bit about what my strategy is, or I'm at least going to tell you how you can find out exactly what my strategy is with elephant.money. What am I going to do? Which one of these strategies, if any, am I going to use, or which combination of these strategies am I going to use? I'll tell you how you can find that out as well. First thing, let's go ahead and get started. Let me just say this. A lot of you have actually asked me to cover this project, and at first I didn't want to cover it because I'm familiar with the developer. I've seen a lot of his projects, and I just thought it was probably the same old, and I didn't really pay any attention. Today I decided, you know what, let me just see what's going on. What has he done different? How does this work? And I was really shocked by something. Like I actually thought, wow, that is a stroke of genius. And we'll cover that kind of when we go into the sustainability and the viability and what's going on there. I wanted to go through and talk about how people are earning with this project. Now, nothing in this video is considered financial advice. I'm not recommending that you join this project. I'm not qualified to give you financial advice. I will share with you what I'm doing. However, my risk tolerance is higher, much higher than the average crypto investor. However, if you want to take this information and go do your own research based on your own risk management, your own risk tolerance, feel free to do that. However, this is what I consider a cottage project. This isn't investing in Bitcoin. This isn't even yield farming. This is a cottage project with primarily one main dev running the whole thing. So with that comes a certain level of risk as well. So you got to understand how to balance your risk before you get into a project like this. So in no way, shape, or form am I recommending that you get into a project like this. Should you choose to get into elephant money, then you do so at your own risk. If you want to help out or support the channel, I will put a link in the description, but you don't even have to use a link. Just go to elephant.money. So let's talk about what are the 3 ways that you can earn, what are 3 elephant money strategies that will allow you to earn a passive income. The first one is, I'm going to start differently. I've seen similar videos, but I don't think enough people talk about this because I think this is interesting. And that is the just buy and hold the elephant token. So the elephant token is a reflection token. And just to explain what that is, reflection tokens pay coin holders without them having to move any money, sign up to any staking pool, or even having to check their crypto wallets. So the question is, well, what do? You buy the token and you will automatically get additional rewards. You don't have to do anything. They show up in your wallet. If you had, hypothetically, 1,000 tokens, then within a day or two, you're going to have more than 1,000 tokens automatically that show up in your wallet and you don't do anything for it. Now, historically, reflection tokens are really interesting. Their reflection token here is quite a bit better, and I'll explain why, and it's part of what I thought was so interesting about this ecosystem, or at least this project. And it has to do with some of the tokenomics. We'll get to that a little bit later in the video. But let me just say this. One of the strategies that people try to do with reflection tokens, they try to build up a bag of tokens. They just want to hold the tokens. They want to take those reflection rewards they're going to get every day and maybe sell them every day. I don't typically like that strategy because you're going to be susceptible to the token price. And these reflection tokens can be extremely volatile. But one strategy is just hold the token, sell off the reflection rewards. It's hard to say exactly how much they're going to be. It depends on the volume, the number of people that are buying and selling the token. Any transaction inside the ecosystem with the elephant token pays a 10% fee or a 10% tax or whatever you want to call it. So if you buy $10,000 worth of elephant tokens, you're only going to get 9,000, and the other $10,000 worth will get, the other $1,000 worth will get basically distributed across the entire ecosystem to every wallet address that is holding tokens, proportional to the amount of tokens that they're holding. If you go to sell $10,000 worth of tokens, you're only going to get $9,000. Maybe you sold for BNB, for example. You would get $9,000 worth of BNB, and the other 1,000 goes out in reflection rewards. But when you're holding that token just in your wallet, you're getting all those reflection rewards that's coming through the ecosystem as well. And if the price goes up and you're getting reflection rewards, that's even more incredible. So the first strategy is you can hold the token and you can sell the reflection rewards every day or whatever you want to do. Again, all this is risky because you're going to be susceptible to price movement of the elephant token in and of itself. The second strategy, you're going to have less volatility. So you're not going to have to worry about the price dropping as much. And that is using the trunk token. So this is kind of crazy. And this is very interesting. This trunk token is a stablecoin token. So this thing is backed 75% by BUSD and 25% by the actual elephant token. So it's partially backed by BUSD. So you're still going to be somewhat susceptible to the elephant token ecosystem. Right now, it wouldn't even matter. I mean, that's just a crazy, crazy looking chart. Can it sustain itself? We'll talk about that in a minute. I don't have any right now, but if you had trunk token and you come over here and you deposit it, what you do is you take BUSD and you put it in here. You click mint. You need to actually click that button first, and then click mint. You'll get $100 worth of trunk tokens. You take the trunk tokens, you click deposit, and at that point, you're going to get 66% APR right now. And this APR will go up and down. It's been as high as 90%. It goes up and down. But the thing is, you at any point in time, that's on top of your $100 worth of trunk tokens, or your $1,000, or your $10,000, or your $500,000. It doesn't matter. Those trunk tokens are you can withdraw those at any point in time. Just come here to withdraw. You can withdraw those trunk tokens at any point in time. You can sell them. You do pay a 1% fee when you sell them. So you basically get 99% of your tokens back. But you're also going to get whatever APR you've been earning as well. I don't know anywhere in the world where you can get 66% APR on a stable coin, a US dollar value. So that would be the second way, is basically just mint trunk tokens and deposit them. It's incredible. So the question is, where does this APR actually come from, and is this APR sustainable, and how is it sustainable? We'll get more to that in just a moment. The next way you can earn, the next highest APR you can get is going to be right here, depositing what they call the Stampede Perpetual Bonds. Basically what this means is you buy your trunk tokens, you come over here, you go to bond, you deposit your trunk. When you deposit your trunk, you do not get them back. They're not burned, but just consider them gone. They're into the smart contract. Now, I'll show you in a moment where you can find out where they're at. I have a resource I'm going to share with you that breaks down all the tokenomics and all the movement of this entire ecosystem better than anything I've ever seen. And I'm going to share that resource with you in a moment. But what's most important for you to understand is, if you deposit $10,000 worth of trunk in here, you're not getting it back, but you do get 0.56% back every day up until you max out at 205% APR. Then basically you're done. So you're going to essentially, theoretically, you're going to double your money at a rate of 0.56% per day. That would give you a 205% APR. And the way it works is, you come over here, you're going to bond, and your number will show up here, your number of trunk will show up here, and then you're going to be earning 0.56% per day. You can roll, you can keep compounding every day if you want, or you can claim your trunk if you want, and you can sell. However you want to do it. So the three ways to earn money is hold elephant token, collect reflection rewards, sell the rewards if you want to. Or come over here and earn 66% APR in a stable coin that you can withdraw your principal at any point in time. Or if you want to, do something a little more risky, you can deposit your trunk over here, earn 205% APR. You can roll every day, you can withdraw, do whatever you want to do. Those are the three main ways to earn inside this ecosystem. So the question is, how can they pay this out, and is it sustainable? Now, this is the part, when I saw this, I thought this is really, it's really pretty ingenious. Now, and before we go there, I want to clarify the difference between sustainability and viability. Sustainability means that something is, it can last for a long time, and maybe even an undetermined amount of time, but we know that at some point it probably is going to have an ending. Viability, the way that I define that, means it's viable. It's a viable project that doesn't have any known end in sight. It could go on indefinitely, and there's no reason that we have to currently see that it's going to end. Now, a lot of times what you see a couple different things in projects, and you see that, for example, you'll take a token, let's just say the elephant token. You'll take the elephant token and you deposit into a platform, and you get 1% per day back in elephant tokens. What that does is it creates inflation eventually. Initially, it creates, it can be a little bit deflationary, but eventually it's going to create inflation, because the moment that you have more people cashing out than you have buying in, essentially, the moment that happens, the token price is going to collapse. And when the token price collapses, then your USD value of your rewards is going to go down significantly. And we see this happen over and over again in DeFi. For example, Olympus DAO. Many of you are familiar with the DAOs. They paid out crazy amounts of APR. Everybody was talking about hold it and hold it and compound, hold it and compound, hold it and compound. It didn't matter. Eventually, people were going to start selling. And when they started selling, it was going to drop quickly. And it did drop very, very quickly. I called it on this channel, and it wasn't because I was clairvoyant. It's because I understood you cannot, if you increase supply, at some point, someone's going to sell for a profit. And the first people to sell will win. Period. The people who hold it forever, there are people who were holding this project over here and they're still holding it. And the truth is, the odds of them ever if they bought in over here, they'll have to hold that project forever. Anytime we see inflation in a token supply, we're going to see price drop. We've seen it right now with the Drip network. If the only purpose in the hold that token is to get more of it so you can eventually sell it, at some point, that's going to drive the price down. We're seeing it right now. My Telegram group, one of the things I talk about is I say, hey, listen, at some point, this price, unless the developer finds a reason for people to want to hold the Drip token for something other than selling it for profit, the project is going to eventually collapse. Period. But that is the hard truth. If you can't figure out a use case for people to do something with the token, then the price is going to keep going down because more and more people are going to sell long term. And the faster the price will ultimately drop. Again, you increase supply, you're going to decrease price. Initially, these projects are always deflationary, at least on a circulating supply basis. But long term, the circulating supply will increase as more people start selling. And then it becomes kind of inflationary at that point in time. And the challenge with these projects, same thing with Olympus DAO. The Olympus DAO team, to their credit, knew that the price was going to drop. Early on they said it. Later on they didn't say it, but early on, they understood the price was going to drop early on. If you saw some of their early writings and stuff they talked about, because they had a really high APY, and they understood that they wanted the price to drop is a reality. So, but they kind of shift their focus. But that's neither here nor there. If the only purpose that someone is getting into a project is because they want to sell that token for profit, if that's the only purpose, then is the moment that they reach a profit level they're satisfied with, they're going to sell. Period. There was no idea for most people who were getting into Olympus, for example, it was supposed to be a reserve currency asset. Most people getting in had no clue what that actually meant. Ironically, Elephant token is a little bit better of a reserve currency asset. We can get to that in a moment. But this project was not fully backed by anything. At least it wasn't eventually. And so people were just dumping the token and the price dropped. Let's go over here to Strong. This is a project that I'm in right now, which actually, if you zoom in, Strong is actually having a little bit of a resurgence, which is kind of nice. The developers are talking about changing the project a little bit. So maybe they'll pull that off. We'll have to wait and see. But if you come over here and look at Strong, same sort of thing. People were buying the Strong token to stake the Strong token and ultimately earning Strong rewards. At some point, the price starts dropping once people are into profit. Once they're selling more Strong tokens than they initially bought, the price is going to go down lower than when they bought in initially. So that's just how it works. It's always the case. So what makes Elephant Money different? Well, let me show you a project that we covered in our last video. Remember when I showed you LooksRare in our last video? If you haven't seen it, I'll link it above. You can take a look at this. This is a project where you buy the Looks token. It's an NFT platform, and the profits from the platform get distributed to all token holders. All token holders. But the profits in the platform are distributed in ETH. People buy and sell NFTs. Look, they buy and sell these NFTs with Ethereum. Notice all the prices are in Ethereum. So that's how they buy and sell these NFTs. Well, the profits that the platform gets, the platform earns those profits in Ethereum. They have two options. They could have designed it so they took that Ethereum and they use it to buy LooksRare tokens, and then they distributed LooksRare tokens. But very few people want to hold LooksRare tokens long term, just to get more LooksRare tokens. But what LooksRare does is they distribute their profits in Ethereum. So you buy the LooksRare token, and those of you, this project has popped hard since I even talked about it just a few days ago. You buy the LooksRare token, you stake it on the platform, and when you stake it on the platform, you're going to earn rewards in Ethereum, and you're earning those rewards right now at 97% APR. When I talked about it, it was 104% APR. Where does that APR come from? They're not able to print Ethereum. That APR is coming from profits on the platform, and they're not diluting their token. They are a little bit, that 63% APR, you see that there, but 63% is not a lot of dilution in crypto. However, there's a minor amount of dilution, but the majority of the rewards, 2/3 of the rewards, are coming from Ethereum. Now, that all of a sudden makes this Lux token very valuable. We'll take a look at the Lux token. It launched like a lot of projects in DeFi. It went crazy. Let's see. It went way up, and it came down. And now it looks like it's building a base, and it's starting to go back up. Why? Because you're earning 90% in a blue chip asset. That sort of APR, 97%, that's your APR. And a lot of people, myself included, think that ETH is going to go up long term. So theoretically, you're actually earning more than 97% because that's in today's pricing. So the Lux token ends up being, it doesn't get devalued because of itself. Does that make sense? Meaning it doesn't devalue itself over and over again like a lot of projects, like Strong does, for example, like Olympus does, like so far Drip has. And all these projects are in development. So just because I'm naming names today of projects, it doesn't mean I have anything against these projects. I'm still holding Drip. I'm still holding Strong. I'm compounding every other day in both of those. So, we'll see where they go long term. The only one I'm not holding right now is Olympus DAO. But so these projects long term may change, but they are going to have to change in order for them to be able to continue. They cannot continue forever. They are not viable, and they're not going to be sustainable much longer. That's why both their token prices have dropped significantly unless there's changes to the platform, because they're giving you the same token you buy is the same token you're getting rewarded in. But that's where something's a little bit different with Elephant Money. And let me say this, when I saw this today, I was like, wow. And I got to give a big shout out. I told you there's a resource that really breaks down these tokenomics really well. I'm going to show you this flowchart right here. This flowchart comes from a YouTuber who's got a small channel into crypto. By the way, I'll just quickly give his channel a shout out. Come check out his channel, subscribe. You see I already hit the like button. Come subscribe to this guy's channel. I mean, he did in this 12-minute video, he did one of the best explanations I've seen of the tokenomics, and he created this very complex flowcharts, and they're complex. But here's the key to this entire system, and I'll tell you how you can find out what my strategy is. Because my strategy, that you can earn 200% APR right now. The highest APR you can get is about just over 200% inside the Stampede. But I'm looking to earn about 300% this month. That's my goal, 300% this month. And if you want to know what strategy that is, I'll go ahead and tell you now. Go down the description, subscribe to our Crypto Passive Profits newsletter. Because here in another day or two, I'm going to send out an email directly to my newsletter subscribers, and I'm going to share with them exactly what my strategy is with Elephant.money. Now, the reason that I'm not saying this publicly, well, anyway, I don't even want to drop any hints. I don't want to drop any hints, so I'm not going to say anything. But just go down in the description, subscribe to our Crypto Passive Profits newsletter, and here in a couple of days, I'll share with you exactly what my strategy is. But here's what makes this, and again, shout out to Into Crypto for pointing this out. Here's what makes this so incredible. In Stampede, you're getting 66%, in Trunk, you're getting 66% APR. What is that APR getting paid out in? It's getting paid out in Trunk rewards. What is Trunk rewards a representative of? It's a representative of the US dollar value. One Trunk equals $1 roughly. That's the goal. It's a stable coin. Down here, you're depositing, you're basically locking up or giving over you're purchasing bonds by giving up Trunk. Again, US dollar value. You're getting that APR back 0.56% per day in an APR that is a USD value. Why does this matter? Because where's that US dollar value coming from to be sustainable? It's coming from the Elephant token. Take a look at this. Whenever you mint Trunk, a portion of that minting, I think it's about 50%, goes to the Elephant treasury. Anytime that you're doing bonding on the Stampede, a portion of that, I think it's 50%, goes to Elephant treasury. Sorry, it's not 50% of mint. It's smaller than that. But anyway, it's a portion of it goes to Elephant treasury. Stampede, it goes to Elephant treasury. When it goes to the Elephant treasury, what it's essentially doing is adding buy pressure. I'm just keeping it simple. It does more than that. Again, go watch Into Crypto's video. I'll link it above. I'll put it in the description. You can go watch it. But essentially, you're adding buy pressure to the Elephant token. And the treasury owns 50% of all the tokens, of all the Elephant tokens. And remember, it's a reflex token. So it's getting reflex rewards on top of that. So all of these create strong tokenomics that push the price up, which is why the price looks like this. So just if you come over here, what was this, the 28th of February? The 28th of February, if you look at that price there compared to, let's see, I think that's 6x that it went up right there, 6x. Because the prices went up so significantly and it's paying rewards out in USD value, but the whole thing is being underpinned essentially or supported by a token who has some tokenomics that are designed to drive the price up. Now, there is a risk that the token can pull back. We'll talk about that in a moment. But as long as the elephant money price can stay higher than the total APY being paid out by the system, it will definitely be sustainable indefinitely, as long as that can happen. But in order for that to happen, the price has to keep going up. Now, how often do we see price go up and never come back down? That's where it starts to get a little bit tricky. Essentially what happens is if the price pulls back sharply, you're going to see a bunch of people say, hey, I don't want to be part of this volatility. So what are they going to do? Well, a certain percentage of them, and maybe a lot of them, are going to want to go into stampede. Why? Because they don't have to worry about that price volatility, and they can just get a consistent. Humans like consistent returns. So they can get a consistent 0.56% per day, 205% APR. They can roll it every day if they want to. They can compound it, etc. Every single time that they come in here with new tokens and they create that bond, then they're adding buy pressure to the reflex token. Because 50% of the amount that is bonded, most people are coming into this bond here because they want that, again, human nature. They want that perfect 0.56% APR every single day. When they come in with this APR, they're also adding buy pressure to the elephant token. I told you, the good, bad, the ugly. So what's going to be interesting is at some point, 0.56% is a small enough number that if the community is large enough, it could probably pay this out if the community is large enough for, who knows, a couple of years, 18 months, a couple of years, it could pay this out. But what's going to happen is what happens when there's people pulling out massive profits out of this project right here. When you finally get to the point, it will take a lot longer. You can almost look at lifespans. Look at how quickly, just in a few months, Olympus died. But if you look at a project like Drip, I mean, this thing is going on for, I think we're coming up on a year now. And you can see this curve has taken, the better part of a year to complete. And that's normal. If something's paying out about 1% per day, if it gets a decent-sized community, we've seen this over and over in the crypto space, then you can see price be supported even at a 1% per day. You can see the price be supported for, it's about a year. It's closer to a year than it is 18 months in most cases without any sort of adjustment to the ecosystem. So now that Elephant Money is paying out 0.56% per day, and they're paying it out by being able to use a token like the Elephant token, which is designed to go up in value, then potentially that could go on, that could be sustainable for a very long time. I do think right now, and listen, if you can articulate how, I'm wrong here, I'd love to see it in the comments. But at some point, when there's enough people withdrawing on this APR, and they're making more profit than they put in, at some point, I believe that the price could start dropping in the Elephant token. When payouts exceeds bonds in a unit number, not a USD value, in a unit number, I think that could get interesting as well. I'm not really sure what that would mean long-term for the entire ecosystem, but do I think it's going to last 20 years? No, I don't. Not with some sort of change. But do I like the mechanic of the Elephant token underpinning the whole thing, and the Elephant token has tokenomics that are separate from the US dollar value? I think that is very interesting. And what I find interesting about these cottage projects is I'm always thinking to myself, there's some sort of real world use case to this. These tokenomics are interesting. What if, for example, LooksRare, I don't know what would happen, but what if LooksRare was actually a reflex token? I don't know. I find that sort of stuff kind of interesting to think about. And then what if LooksRare had a treasury that was also holding reflex tokens and that was getting the reflections as well? What would that do to the token value? Ultimately, I guess it would start pulling the Ethereum rewards. It's hard to say. It's very interesting to think about. The thing that I love most about these cottage projects is I'm always thinking about how could that interesting tokenomic be used in the real world. And when you consider something like, you look at projects like the Titano out there and the Titano forks like Seifu, and you look at, I know someone just said Seifu's not a Titano fork. Either way, the mechanics work similar, just a higher APY. But when you see projects like that, and you see projects like SafeMoon, for example, and then you see something like Elephant, which is a reflexive token still, or reflection token still, but it's just one component of this entire ecosystem, you just wonder to yourself, like, what could happen? Like, this thing could be a vacuum cleaner. Like, it could suck up a ton of funds potentially. I mean, a ton. Let's see where we're at right now. It's hard to say. Like, this thing could go to $1 billion, 10 billion. It could, because whenever you see 66% APR, and evidently this APR can go down, but I read somewhere where it was programmed to be limited at 30% APR. I'm not certain how that works. But you're talking about getting a 20 or 30% APR on a stable coin. All you have to do is go over at the Terra ecosystem and look at how much money is tied up in Anchor Protocol, which pays a 19% APR. Now, that's a proven product, but in the beginning, Anchor wasn't proven either. And if you want to know what, look, Anchor right now has $14 billion in TVL. $14 billion in TVL, paying 19%, which they've already announced is not going to be sustainable much longer, and they're about to go to a variable interest rate where it will drop down. The sustainable interest rate, I'm told, is around 9% APR. But at 19%, they managed to get $14 billion. Now, I'm not going to sit here and tell you that something like Elephant Money is going to do that. But if we woke up a year from now and you're like, hey, Wealth, you know Elephant Money is sitting at $19 billion, I wouldn't be terribly surprised either. Again, nothing in this video is financial advice. If you want to find out exactly what strategy I'm using in this ecosystem, go down the description, subscribe to our Crypto Passive Profits newsletter. Here in the next couple of days, I'll send out a video just for my subscribers. In fact, I'll record it here in a moment, just for my subscribers, so they can see exactly what strategy I'm using with Elephant.money. I don't recommend that you come into this platform because, again, it is high risk. But I find these cottage projects very, very interesting. And there's a window of opportunity, and if you seize that window of opportunity, they sometimes can be profitable. But that profit isn't without risk. It is worth pointing out this project is audited by, they do have a Certec audit on this project, which I think is very interesting. You can come over here and you can see the Solidity Finance and the Certec audit. All that means is we should be safe from a smart contract risk. I think people overvalue audits. In crypto, you just always have to diversify. You have to create a strategy where you can be right even when you're wrong, because you're going to be wrong when you make investments. The best projects can go south, and the crappiest looking projects can do very, very well. Thank you so much for watching. Decentralized cryptocurrency equals freedom. This is Crypto Wealth. I'm out.